In this video, I'm going to talk about Mid-America Apartments, ticker symbol MAA. Mid-America Apartments is a REIT, or a real estate investment trust. And personally, they're my favorite REIT. They're the only REIT I hold in my stock portfolio. So I'm going to give a really quick synopsis on them. I'm going to just give a really quick introduction on them. And then I'm going to talk about their most recent earnings release. They had their most recent earnings release on October 27th. So I'm going to talk about their financials very quickly. And I'm also going to talk about a small part of their most recent earnings conference call that was also released on October 27th, that they had on October 27th. So anyway, here, let me just give you a really quick introduction to them. So they're the largest owner of apartments in the United States and the 7th largest apartment property manager in the United States. And here's their income statement. Here, let me show you their property portfolio. Here it is. Okay, their property portfolio. So you can see they have almost exactly 100,000 total multifamily units, which makes the math kind of easy because right, you can see that they have a little over 10,000 multifamily units in Atlanta, so we can just say 11%, then 10% in Dallas, 5% in Tampa. And the interesting thing about their property portfolio is that, as you can see, it's almost all in Texas and Florida, right? I mean, their biggest holding is in Atlanta, but, right, I mean, almost their entire portfolio is in Texas or Florida. And even the ones that aren't, so Texas and Florida, right, they're basically, over the past couple of years, really over the past like 5 or 10 years, they're the areas of the U.S. that have had the largest property appreciation and that are most likely going to have the largest property appreciation moving forward. And you can see the properties that aren't in Texas or Florida, right? You have Richmond, Virginia, Charleston, South Carolina. These are all very good cities for property appreciation. And then Phoenix, where's Phoenix? Yeah, Phoenix, Arizona. So just a great portfolio, pretty much in the Sun Belt of America. And so that's their portfolio right here. And I really quickly want to talk about their financials. And normally, when you look at the financials for a company, the most important thing, well, I mean, you have their cash flow statement, the income statement, right? And one of the things that you mainly focus on is net income, right? But for REITs, you don't only have to look at net income and cash flow, but REITs, they also normally have something called FFO, funds from operations, AFFO, adjusted funds from operations, and core AFFO, so core adjusted funds from operations. So yeah, it can get a little bit confusing, but it's actually not that confusing. So let's quickly talk about that in this video. Talk about what the differences are. They're very minor differences, actually. But let's first look at the income statement right here. So their income statement, right, in the most recent quarter, they had revenues of $520 million, and their margins were around 25%, or you can see, yeah, 22 or 23%. So they earned $1.05 per share. So their expenses right here, right, real estate taxes and insurance, depreciation and amortization. And so, well, I'm not going to spend too much time on their income statement. I mean, it's a pretty standard income statement. But let's talk about the reconciliation from their income statement, from their net income to what I referred to earlier, FFO, funds from operations. And so, yeah, you can see this. So okay, so this is from the most recent quarter, right? You can see $1.05, most recent earnings per share, $1.05. So their earnings per share for the most recent quarter, for quarter 3, fiscal quarter 3, and calendar quarter 3, $1.05 per share. But their FFO, funds from operation, $2.19. So how did they reach that number? What's the reconciliation? Okay, so what I've done right here, I basically highlighted each box, each important box. So you can see their net income, 121 million. You can see that here, right? That was their net income for the most recent quarter, 121,389,000. And the only difference between net income and funds from operation is this right here. So depreciation and amortization, and then well, you've got some other stuff, and then net income attributable to non-controlling interest, and that's it. And then you get FFO, and then FFO to core FFO is just basically some loss on investments, loss or gains on investments, normally hedging gains, stuff like that. So the difference between FFO, funds from operation, and core FFO, so core funds from operations, is pretty minor. And you can see actually it's not always the same, but in this quarter, their most recent quarter from Mid-America Apartments, it was the same. So their FFO and their core FFO is $2.19 for the most recent quarter. So their net income per share, $1.05. Their FFO and core FFO, $2.19. And then their core AFFO, so this one right here, can you see that? Yeah. Core adjusted funds from operation, right? The only difference between core FFO and core AFFO, recurring capital expenditures. And then you get core, and that's just CapEx, capital expenditures, but it's just, well, what it says, recurring capital expenditures, so they account for it a bit differently. But anyway, and that's it, that's all it is. So you have their EPS, their FFO per share, core FFO per share, and core AFFO per share, so core adjusted funds from operation per share, and that's 186. And then you also have their EBITDA, right? EBITDA is just earnings before interest, taxes, depreciation, amortization, and that's pretty standard. I mean, that is a non-GAAP metric, but it's not uncommon at all for a country, for a company to give their EBITDA, right? So it should be something that you're pretty familiar with. So just net income plus depreciation, amortization, interest expense, income tax, and right. I mean, you would expect it to be kind of similar to their FFO, because net income plus depreciation, and well, as you can see, it is. So FFO and EBITDA are pretty similar. And then they have something that, I mean, only REITs really adjust for this, EBITDA RE, and then adjusted EBITDA RE, and that's not so important to talk about. I mean, there are enough metrics here that we talked about. But EBITDA RE, adjusted EBITDA RE, as you can see, there's not really that much difference between these two and EBITDA and or FFO. So really, the main four metrics that, in my opinion, are the most important here are their net income, FFO, core FFO, and then core AFFO. Right? So, and really, mainly, if I had to pick two as the most important, just net income and FFO. FFO is funds from operation. And so right here, I have the per share amounts for the most recent quarter. And then right here, I have the dollar amounts for the most recent quarter. And as you can see, yeah, FFO, core AFFO are all about the same. And then right here is the guidance that they gave in the most recent quarter. So right here is, so yeah, and right here is their release, their earnings amount every quarter. So last quarter they earned 182 of EPS. The quarter before that, 95 cents for their EPS. But right here is their guidance for every quarter. And sorry, let me just clarify. This is their yearly guidance, but they update their yearly guidance every quarter. So in quarter one of 2022, their yearly guidance was $6.12 EPS. And then their property revenue growth guidance was 11%. And then you can see how that has evolved over the quarters. So, right, this quarter, their yearly EPS guidance for the most recent quarter is actually less than their EPS guidance on quarter one, so 6 months ago. But their FFO guidance is higher, their AFFO guidance is higher. But then look at this right here, their property revenue growth, property operating expense growth, and net income from operations, or net operating income growth, is higher than it was in quarter one. And you can see, I mean, these numbers are pretty good right here, right? Property revenue growth, 13.5%, property operating expense growth, less than their property revenue growth, and then their net operating income growth, 17% for the year, right? So they're estimating that their net operating income will grow 17% for fiscal year 2022. So, and then right here, I just have their basically, well, so here's their share price, 160.28, and then here are the ratios. So they're trading at 28, so you can see right here, right? So they're trading at 160 per share, and their estimated EPS growth for 2022 is 567. So, all right, simple math, they're trading at $28, a little over $28 per share. Or that's their PE, a little over 28. But, right, that sounds kind of expensive. But for one, they're growing fast. And then for two, well, you can go by EPS or you can go by FFO, right? If you go by EPS, they're not insanely expensive. I mean, that is pretty expensive, but they are growing pretty nicely. You've seen their property portfolio is pretty, where is their property? Yeah, their property portfolio is pretty good. And then, yeah, so for their core FFO, they're estimating that their core FFO for fiscal year 2022 will be $8.45 per share. So trading at 18, or we'll just say 19 times full year core FFO, and then 21 times full year core AFFO. All right, and then there's one more thing I want to talk about. So here's our net income statement. Here's the reconciliation from net income to FFO, core FFO, AFFO. And then right here is the balance sheet. And I'm not going to spend a lot of time on this, just really quickly. You can see their balance sheet is pretty good. They're about, so $11 billion balance sheet. They're about half equity, half liabilities, or a bit more than half equity. And then most of their liabilities just unsecured notes payable. And here, let me put this over here so you can see that right. So yeah, they have a little over $4 billion of notes payable. And there's a breakdown right here, actually. So they have 4.154. And then, yeah, here it is. So unsecured debt, $4,154,000. And then they have secured debt as well. And that is here, secured notes payable. So yeah, pretty much all of their liabilities is just loans, pretty much, notes payable. And you can see most of that is fixed rate. And then it's pretty cool because not every company does this kind of thing, and not every company gives their debt. Not every company says when all of their debt is coming due in the rate case, but right, this one does. So you can see all of their debt in 2023. They have 350,000, or well, that's in thousands, so 350 million of debt coming due in 2023, and they're paying 4.2% interest. So you can see it's pretty even. So every year for the next 10 years, they pretty much have an even amount of debt coming due, and they're paying fairly low interest on that debt. And then you can see the rating right here. So, right, Fitch gives them an A-, Moody's gives them Baa1, Standard & Poor's gives them A-. So pretty good credit ratings. They're paying pretty low interest on their debt coming due. They don't have an insane amount of debt coming due imminently. Pretty good balance sheet, pretty good income statement, pretty good everything, right? Pretty good property portfolio. So very good company, in my opinion. Like I said, the only REIT that I hold in my portfolio. Mid-America Apartments has increased, including with dividend payments, they've increased 85% in the past 5 years. That's including dividend payments, right? But that's a pretty good return, 85% in the past 5 years. And then there was one part of their earnings conference call. Obviously, it would take way too much time to go over their entire earnings conference call. But I just want to point out something that I found in their most recent earnings conference call that I thought was interesting. So they say, strong demand for apartment housing across our portfolio drove a 16% increase in leasing traffic volume as compared to last year's third quarter. So they're actually seeing an increase in volume compared to last year's third quarter. We are seeing a return to more normal seasonal patterns. We are seeing a return to more normal seasonal leasing patterns with slower leasing velocity that is typical during the coming holiday season. All right, at this point, we've not seen any evidence of weakness in the drivers of demand for apartment housing as it applies to our Sunbelt portfolio. So as of this point, they've not seen any weakness. The third quarter, 15% of our new residents were relocating to the Sunbelt from coastal markets. So coastal markets, they're probably mainly talking about California and or New York. And so yeah, they're saying that out of all their residents, 15% are relocating. That's kind of a lot. Leasing traffic is high and resident turnover or move-outs remain well below long-term trends. We are seeing no signs of stress in terms of affordability with rent-to-income ratios on leases completed in quarter three. Over 99% of bills rent being collected. So yeah, you can see they're having no problem here. They're seeing no weakness. People are paying their bills. People are renewing. When I say people, I mean renters. Renters aren't having any difficult times paying their rent, keeping up with paying their rent. So that's very bullish for MAA, Mid-American Apartments. So yeah, good financial statements, good earnings conference call. So definitely I would recommend this company, or if you're interested, I would recommend looking into it further. Like I said, my favorite REIT, I hold them in my portfolio. I've held them for a long time. I would definitely recommend them, and thank you for watching.